All right, so the last thing we need to talk about here are these closing details. Honestly, not a lot here. In fact, you'll see there's only going to be 3 questions that they're going to ask you. That it will be on the state portion of the exam, but it's just 3 questions, so it's not a lot of stuff. But it does seem like quite a few people have some issues with it. So let's take a look and see how this what all this pertains to. And honestly, it's about closing. That's what we're talking about. We're going to closing, go officially transfer property from the seller to the buyer, and we're going to sort of look at what everybody's roles are in the closing, and how to do a little bit of math, because I think that's what people are having some issues with. So we'll talk about that. Well, to start off with, you'll see here, when you have a real estate closing in South Carolina, it has to be performed by an attorney. I would remember that. They could ask you something like that. But in South Carolina, and I'm emphasizing in South Carolina because this is not true in every state, but in South Carolina, you have to have an attorney to close. It's the only way to do it. Some states will allow you to use title companies and stuff like that, but that's not South Carolina. You must have an attorney to do this. The attorney is going to prepare what we call the CD, or closing disclosure, or for short we call it CD. That's what some people refer to as the settlement statement. That term should sound familiar to you. Back in the finance chapter, if you recall, we talked about some of these terms then. So I hope a lot of the stuff we're going to go through in this 1-hour module is just refresher, because that's what it should be. But then you'll notice this last bullet on the slide here. It says possession typically takes place at closing. Well, what is possession? Possession, at what point does the buyer now own the property? In other words, when do they have the keys to the property? That's possession, because when you turn over the keys represent possession. So when does the buyer get possession? Typically at closing. Once all the money's been paid, the attorney's collected the monies, whether it be from a loan or whatever, and then once all the documents are signed, that's when the keys are turned over. But I say it's typically at closing because this is not on every situation. And I'm going to tell you, as an agent, especially as the buyer's agent, you better read the contract, because some of these contracts actually read that possession will take place 24 hours after closing or 48 hours after closing. And that could be an issue if your buyer shows up to that closing table with their U-Haul truck thinking they're getting ready to move in, and they find out they can't move in until this time tomorrow or 2 days from now or whatever. That could be an issue. So just make sure you know what the contract says. Okay. So what's the closing agent's responsibilities? Well, first of all, who's the closing agent? Hopefully you've already figured that out, but that's the attorney. That's not the buyer, or it's not a real estate agent. The closing agent is the attorney. Just another name for the attorney. Well, what's the attorney or closing agent's responsibilities here? Well, you see a list of things here. I'm not going to sit here and read these to you. One, you can read them, and they're in your book, in your material, so you can look at it there. But at the end of the day, what is all this saying? The attorney's responsibility basically is to prepare the closing disclosures, the settlement statements, prepare any other documents that might be necessary to make this a legal, valid transfer of property. So they'll prepare all the documentation, make sure everybody's signed where they're supposed to sign, get it recorded. They will also do that part of it. And that's really all the attorney does. And just as a side note, I want to make sure you're clear on what the attorney does not do. That is kind of mistaken by a lot of real estate agents. the attorney's not going to check your files to make sure you have, as the real estate agent, make sure you've got all the documents you're supposed to have. Primarily disclosures of certain type. Like remember if the house was built prior to 1978, you must have a lead-based paint disclosure signed by all parties. Everybody's got to have a copy of it. That better be in your file. That's the law. But is the attorney going to check to make sure you did that? No, not the attorney's job. So the attorney's not going to be checking on or following up behind you, the real estate, to make sure you did your job. They're just going to do their job. And their job is to prepare the final documents for transfer of property, get them signed, and get it recorded. And then lastly, you will notice, assuming the buyer is buying title insurance, which again, that was covered in a previous chapter, the attorney will issue the title insurance policy. And again, all that's provided at closing. But that's what the closing agent does. That's it. All right, so here's where I think most people have the issues in this area. Again, there's only 3 questions, and probably at least 2, if not all 3, will be in some way, shape, or form a math question that deals with closing. Well, you see about 3 types of math or 3 subject matter they could ask you about. Mortgage interest, and we're talking primarily interim interest. Again, we talked about that in the finance chapter, but we're going to go over that a little bit here right now. But you got to be able to calculate or prorate what the interim interest will be that the buyer will owe. We got to be able to prorate property taxes, because seller's going to be responsible for a certain amount. The buyer's going to be responsible for a certain amount. And we'll go over that. Same thing with HOA dues. That's got to be split between the two, so we got to prorate that. And we're going to go through and look at examples of all of those. Now, before we get into the actual math, and again, I hope this is something you remember from previous chapters, but when you're prorating items, that proration has to be based on either a 360-day year or a 365-day year. One or the other. The difference is this. If you're using a 360-day year, that means you must assume there are 30 days in every month, regardless of how many there really are. You must assume 30 days in every month. If you're using a 365-day year, now you're going to have to know exactly how many days are in each month. Of course, as you know, there are a different number of days in each month. So that's what we call the legal year. But anyway, so which one are we going to use? Well, attorneys typically and almost always prorate based on a 360-day year. And that's what we're going to be using in this module, and what I suspect you'll be using on the state exam. In fact, here's the instruction I would give you. When you're prorating, always use a 360-day year. Unless, the only time you would not do that is if it specifically tells you in the question. Use a legal year or a 365-day year to prorate. If it tells you to do that in the question, then obviously that's what you have to use. And it will be a slightly different answer between 365 and 360, depending on which one you wind up with. But if it doesn't specifically say use a 365-day year, use 360. That's the one we're going to go with. Okay. So the first thing we're going to prorate is the interim interest. Again, you should have seen this back in the finance chapter, but we're going to go over a problem right here. And here in the question, it says we're closing on November the 15th. The buyer is going to borrow $175,000 at 6.5% interest. Using the 360-day year, what's the interim interest? Well, let's make sure you understand what interim interest is, because that is important to be able to understand what we're doing here. If we close on November the 15th, when is the first payment going to be due? And look, the due date, the payment due date is going to be the first of the month. Okay? It's going to be the first of the month. Could we make it, so does that mean it would be, if we close November 15th, would that make the first payment due December the 1st? No. And the reason for it, there has to be a minimum of 30 days from the time you close before the first payment can be due. So obviously December 1st would not be 30 days, not from November 15th to December 1st. So it'll have to be kicked to the first of the next month. So that would make it January the 1st. That would be the first payment. Well, when you make that payment on January the 1st, obviously that payment will include, at a minimum, a certain amount of it will go towards principal, paying off the house, but a good amount of it is going to go towards interest that you owe. Well, the interest portion of that payment is for the previous 30 days, because the interest is always paid in arrears. So when you make that payment, what you're really paying for is what you owed from the previous 30 days. So obviously, so when I make the payment January 1st, that covers the interest I owe from December 1st through the end of December. That's interest paid in arrears. Well, the problem is that only covers the month of December. We're closing in November, November 15th. So you still owe some interest from November 15th through the end of November, right? That's what we call interim interest. We have to figure out how much that interest will be. And the reason that's important is because the buyer will have to pay the interim interest at closing. So buyer, that will be part of your closing cost. So we have to be able to figure out how much that's going to be. Well, not hard at all. So let's take a look here. First of all, we have to figure out, well, how much is the annual interest? How much interest are you paying per year? All you have to do there is take the loan amount, $175,000, times whatever the interest rate is. In this case, 6.5%. And you'll see here that $175,000 times 6.5% is going to be $11,375. So that's the interest you're paying per year. Okay? Well, not a whole lot we can do with that, because what I need to know is how much is that interest per day. The whole year is not going to help. I need to know, well, how much is it per day? Well, take the annual interest, $11,375, divided by the number of days in the year. Remember, we're using 360. Don't mess that up. So you divide that by 360, and that gives you $31.59 per day you own that property. That's what you're paying in interest, $31.59 per day. Now that I know the daily interest, now I got, well, how many days are there from the date of closing till the end of the month? You always have to count the day of closing. Y'all do not forget that, or you're going to be off a day when you calculate your math. And I promise you, if you miss the day of closing, you're off one day. Whatever that other answer, that will be an option or possible answer for you as well, because they know that's a common mistake people make. They do not add for the day of closing. So from November the 15th through November 30th, remember 30 days every month, that's going to be 16 days from the 15th through the 30th. So then you just take the $31.59 per day times the 16 days, and that gives you an interest due of $505.44. That's all there is to it. That's all there is to it. And I know I might be going through this a little bit fast, but it's pretty cut and dry. If you need to rewind, go back and look at it again, do that. But again, remember this was also covered back in the finance chapter, okay? So if you want to look there as well, you can. But that's all there is to the interim interest. All right. Now let's look at how we prorate the property taxes. Now, before we even get into it, look, here's where I think when people have problems on the exam, here's where the problem lies. I don't think it's too hard to figure out how much the proration will be, the actual math. Where a lot of people tend to have problems is whether is this going to be a debit to the seller or a credit to the seller? Is it going to be a credit to the buyer or a debit to the buyer? We have issues with the credits and debits for some reason. And it's really not that, this is not that hard. In fact, let me give you a few things that if you'll remember this, you should have no problems. Obviously, make sure you know what credit and debit means. A credit, whoever's receiving a credit means they're receiving money. A debit means it's being deducted from their proceeds. They're losing money, right? So the credit goes to one that's receiving money. The debit is the one that's having to pay out the money, just to be clear there. Well, when it comes to the property taxes, again, property taxes are always paid in arrears, okay? So when are property taxes due? And it's always going to be January the 1st. That's when it's due. But the tax, when you receive that bill that's due on January the 1st, and this is important to understand if you're going to get this right, but that's the taxes you owed for the previous year. Again, taxes are paid in arrears. So even though I'm making that payment on January 1st, that's not for the upcoming year. That's for the last year, the previous year. That's what you're paying for. Now, most people actually receive the bill. The county will send out the tax bill usually around the end of October, first part of November, somewhere in that time frame. So quite frankly, as you see in this question, if we're closing on November the 15th, there's a good chance we've already received the bill. They've already mailed out the tax bill, but it's not due. I'm not saying you can't go ahead and pay it, but it's not due till January the 1st. Okay? So let's think about this. When the county sends that bill out, and I know in the question it says we're closing November 15th, but let me give you another example real quick just to make a point. Let's say we're closing July the 1st. July the 1st. Obviously that tax bill has not even been mailed out yet, so we don't know how much the taxes are. But somebody buys the house and they close on July the 1st. Well, when the county sends the bill out, which will be at the end of the year, who are they going to send the bill to? The buyer, the new owner of the house is going to get the bill, and that bill is going to be for the entire year. So the buyer will have to pay for the full year worth of property taxes. But they didn't buy it until July 1st. So that means from January the 1st all the way up until July 1st, the seller should be responsible for that part of the taxes, and they are. And that's what we're doing here. So we would have to go back and figure out how much taxes is the seller responsible for from January 1st through closing. And now obviously that means the seller will have to pay the buyer for their portion of taxes. They don't pay the county, they pay the buyer. Why? Remember, because the buyer's the one that's going to have to pay for the whole year worth of taxes. So you don't send it to the county, you just give it to the buyer, and then the buyer is responsible for paying all the taxes. So that means with property taxes, that's going to be a debit to the seller. We're taking money from the seller, and it's going to be a credit to the buyer. Y'all's pretty cut and dry. So almost any time you're dealing with property taxes, it's going to be a debit to the seller and a credit to the buyer. So now we got to figure out how much the taxes will be. So let's take a look here. Again, we're closing November 15th. We're back to what the question originally asked. We know it says here in the question that the taxes are $1,200 a year, and we're going to use a 360-day year, like we talked about before. Well, we know the annual amount of taxes, but remember, I got to know how much it is per day. That's what's important. Figure out the daily amount of taxes. Again, you take the $1,200 we know it is per year, divide that by the number of days in a year, 360, and it says that would be $3.33 per day. That's how much the property taxes cost, $3.33. So now we got to figure out how many days is the seller responsible for? Because what we're trying to figure out is how much is that seller going to have to credit to the buyer. So how many days are there from January 1st through November the 15th? Y'all, and this is pretty easy if you think about it. You have 10 full months, right? From January through October, 10 full months. And we know it's 30 days in a month. So 10 months times 30 days, that's 300 days. But we're closing November 15th. So that's 15 more days in November. So 300 days, January through October, and then 15 days from November 1st to the 15th. So that's a total of 315 days. Because remember, you always got to count the day of closing. That the seller is responsible for. All we got to do now is take that 315 days times 333 a day, and it says that would be $1,048.95. That's how much the seller is responsible for, because they're the ones that owned it and lived there during that time. So we got to give that to the buyer. Again, that's going to the buyer at closing. So the answer, now the way they're going, when you get a test question and they list your 4 or 5 multiple choice answers here, I promise you 2 of the answers are going to read like this. It'll maybe say option or answer 1 would be $1,048.95, credit to the buyer, debit to the seller. But then they'll have the next answer, $1,048.95, debit to the buyer, credit to the seller. And then obviously they'll have 2 more with a different number on it. Same thing, debit, credit, whatever. So, once you figure out how much the taxes are or what the seller's responsible for, then it should be pretty easy. Remember, who's having to pay who? The seller is having to pay the buyer. So that's going to be a debit to the seller and a credit to the buyer. I hope that was that. I don't even know how to say it any more clearer than that. So hopefully that works. But that's how you prorate the property taxes. Okay? Should be good there. Excuse me for coughing. Anyway, so now let's look at how we prorate HOA dues. Now, we prorate it the same way. But here's something you got to keep in mind when it comes to HOA. Now look, when HOA sends out their invoices or their dues or whatever, Some HOAs, they'll have you pay each month. Some you pay each quarter. Some will pay annually. I get that. But you need to pay attention to, in the question, how often you're paying. So you know how much you're paying, how often you're paying it. Now in this question, it says the HOA dues are $550 per year. So we're going to just focus on that right now, and then I'll show you some other things here in a minute. But here's the big difference between HOA and property taxes. Y'all, again, if you need to write this down, what I'm about to tell you, write it down, because this is where I'm telling you where people make their mistakes. The difference between HOA and property taxes. Remember, we said property taxes are paid in arrears. So when you make that payment, that's for the previous year you still owe. HOA dues are not paid in arrears. So if you get the bill, say January 1st, that's for the upcoming year. So you're paying for the year in advance. That's important, right? Because if you think about it, if the HOA dues are, say, due January the 1st, and the seller went ahead and paid for the $550, that's for the whole year. That means buyer, you now owe the seller some money, right? Because the seller was only there up until November the 15th. Buyer, you own it from November 15th through the end of the year. So now we got to figure out how much does the buyer owe back to the seller. And again, we prorate it the same way. You take the $550, we know that's what it costs per year. We got to know what it is per day. So divide that by 360, which comes up to $1.52 per day. That's how much the HOA dues are. So now we got to know how many days will there be from November 15th through December the 30th, right? Through the end of the year, because that's the time frame the buyer is going to own the house. Well, we know there's 30 days in December. That's a full month. Now we got to figure out the number of days from November 15th through November 30th. And again, always counting the day of closing is 16 days. So 16 days in November, 30 days in December, that's 46 days the buyer is responsible for. So $1.52 per day times the 46 days is $69.92. That's how much the buyer has to reimburse the seller for. So now we got to figure out, we know how much we got to transfer here, but now we got to figure out who gets debits and who gets the credit. Well, based on what I just said, that should be fairly simple to figure out, right? It's going to be a credit to the seller and a debit to the buyer, because the buyer has to pay this money back to the seller. Okay? So think about it this way. And maybe this will just be a memory item for you. If you're prorating property taxes, it's always going to be a credit to the buyer and a debit to the seller. I'll say it again. If it's property taxes, it's always going to be a credit to the buyer and a debit to the seller. But if we're prorating HOA dues, it's the opposite. It's always going to be a credit to the seller and a debit to the buyer. I don't know how to make it any more clear or easier than that. Then you just got to do the math, and I'm telling you, this is not hard math. You just got to figure out how much it is, whatever it is you're prorating, how much is it going to be per day. If you know the annual amount, divide it by the 360. That's how many days we're using per year, and there's your daily amount. Now, back to the HOA. What if they send you and you're paying monthly. And I'm just making up a number, but say it's $50 a month. Well, then you take the $50 and divide it by 30 days. That's 1 month. Again, you're just trying to figure out how many days there are, or not. I'm sorry. I'm trying to figure out how much are these dues per day. If they tell you you're paying this much per quarter, right? That's 3 months. So that'd be 90 days. So take that amount of money divided by 90 days, get your daily amount. Y'all, that's all there is to it. I wish it, well, I say I wish. I don't wish it was harder, but y'all, it's just not hard. It's just, it really isn't if you think about this stuff as you're going through it. Okay. Really the next few things here is just common terms, elements, things like that. We already talked about this a little bit at the beginning, but we know the attorney is going to do the closing. They're the ones that collect the funds. If you're paying cash, if the buyer's paying cash, they bring it to closing. If they're getting a loan, the lender sends the money to the attorney. But the attorney collects all funds due. If the seller owes some because they were being debited for taxes or whatever, the attorney is going to collect all the funds, put it in his escrow account or her escrow account, and then at some point we'll disperse those funds out to wherever they're supposed to go at the time they're supposed to go out. Again, prepare all the paperwork, make sure it's all signed, sealed, and delivered. They'll have everything recorded. And then that transfer title, once the seller signs that deed, that transfer the title to that property over to the buyer. And that's really what the attorney is doing. Now, if you look here, you see in paragraph 2, what are the licensee's responsibilities? And the first thing you'll notice, it says, once you sit down at the closing table, you should be done. The reality is, we don't need the real estate agent, any of them, to be at closing. Your job is done, or it should be. Once we get to closing, now it's up to the closing agent. That's the attorney. Now look, we do go to closing just for comfort, so our clients will feel more comfortable that my agent's present, and I'm sure you probably want to go just to pick up your commission check, because that's when you're going to get that. But your job should be done if you did your job. Now here's something I'm going to tell you. I'm going to say it as nicely as I can. When we sit down at the closing table and your client starts asking a bunch of questions, they're saying, I don't understand this. This doesn't make sense to me. Why is this like this, or whatever? Whether you want to admit it or say this to yourself or not, I promise you, the attorney and probably the other agents saying this at least to themselves, you did not do your job. Because you don't show up to closing if there are questions. As whether you're representing the buyer or the seller, you go over that closing disclosure with your client. Make sure they understand every line. Why, all the debits and all the credits. Make sure that they understand what they are, why they're there, and that there's no misunderstandings. Okay? That's your job as their agent. But all this has or should happen prior to closing. What I know a lot of agents do, if their client asks them something they don't understand about the settlement statement, they says, well, don't worry about that. You can talk to the attorney when you get there and he'll explain it. Wrong answer. Now look, the attorney is going to do his best to answer any questions if they have it, but I can assure you that attorney's thinking, you got a pretty pathetic real estate agent. Y'all know I'm being blunt, but that should not be a question coming when you sit down at the closing table. You should already understand this. Now look, agent, if you don't understand it, and that's fine, especially when you're starting out, you may not understand it. Then you need to call the attorney or call their paralegal or somebody there in the office and get clarification. And they'll be more than happy. They will. They'll be more than happy to explain it to you. how they did it, why they did it, what it's for, the whole 9 yards, and then you need to go back and explain that to your client. So obviously, when you're looking at the closing disclosure, you got to make sure you have no questions. You understand it. Now you can sit down and go over it with your client, and then in the next day or two, hopefully we go to closing, and it's smooth as silk. That's the way it should work. Now that closing disclosure, more than likely, will, it could and very likely will contain some confidential information. Things about your client that they probably would not want the public to know about. Okay, but you're going to get a copy of it, because you're required by law. You got to get a copy of the closing disclosure, and it has to be in your file. So the attorney is going to give you a copy of it. You better safeguard it. You better be very careful about how you deal with clients' confidential information. So you want to be very careful with that. All this really saying here, we've talked about in previous chapters. But y'all, there's a lot of documents. There's a lot of paperwork that will be involved with every transaction. Typically, you're going to have a pretty thick file, at least I do, after every transaction. And remember, how long do you have to maintain all these documents? Maintain all these files? Hopefully, you said a minimum of 5 years. That's how long you must maintain in case you're audited. And good chance you could be at some point. All right, and then the last thing we need to touch on are these transfer taxes, or a lot of times you hear it referred to as deed stamps, maybe even called documentary stamps. But it's why they got to have so many names for it, I don't know, but it's all the same thing. But obviously a deed stamp or transfer taxes is what it sounds like. So when you sell your property, that means you're transferring ownership from yourself to somebody else. The state charges a tax. You got to pay a tax to transfer the property. That's what we're talking about here. So we have to be able to figure out how much are these deed stamps or transfer taxes. And you'll see in paragraph 2 there it says it cost $3.70 per thousand of sales price. And again, obviously, it's just like if you buy something at the store. Here's the sales price, but you know you're going to have to pay taxes on top of that price, right? Same idea here. So even though you might be selling the house for $200,000, now you got to pay taxes based on that. And the amount of taxes depends on how much you sold it for. So deed stamps are based on the sales price. And again, it says it costs $3.70 per thousand of sales price, or $1.85 per 500. Now, y'all, I'm going to give you an example. We're going to do a math question here, so you make sure you know how it works. But I'm telling you, y'all, this is a memory item. You must memorize $3.70 per thousand or $1.85 per 500. Y'all, I'm telling you, and you will get a question. You will have to do one of these on the exam. I promise you. And if you don't remember $3.70 per thousand or $1.85 per 500, you will not get the question right, because they're not going to provide that information in the question. That is something you're expected to know as a real estate agent. Memorize it. All right. And then lastly, before we do the question, if you look at paragraph 3 here, if the sales price is not an even 500, then you must round the sales price up to the nearest 500. You never round down. Y'all, if you ever round down, you're going to have the wrong answer. So if you have to round, you must round up, and you'll round up to the nearest 500. Y'all, here's what we're talking about. Y'all, again, the only time you'll have to round the sales price is if it's not an even 500. For example, if it's $250,500, if that's the sales price, do I need to round it? No, that's an even 500. Well, let's just say the sales price was $250,000. Do I need to round that? No, that's an even 500. But let's say it was $250,150. That's not an even 500, so we'd have to round it up to 250, 500. You got, again, round it up to the nearest 500. So let's look at a question or problem here. Said the house sold for $225,000, $300. How much are the transfer taxes? Or they may, in the question, they may call it transfer taxes, they may call it deed stamps, so don't let that confuse you. Well, just looking at that sales price, the first thing you need to figure out, am I okay leaving it, the sales price the way it is, or do I need to round it? And what would you say? Hopefully you said we need to round it, because obviously $225,000, $300 is not an even 500. So we're going to have to round that sales price to $225,000, $500, up to the nearest 500. So now we're doing the math to figure out how much this cost. Well, we know it's $370 per thousand. Well, how many thousands are in 225,500? Well, 225. So you take the 225 times 370. Now y'all listen to me. Where a lot of people, and I see this in the classroom a lot, where a lot of people make their mistake, they'll do the 370 times 225,000. Y'all, there's not 225,000 thousands in the sales price. There's only 225 thousands, right? So don't make that mistake. It's 225 times 370. Well, that gives you $832.50. But remember, we had to round that sales price up to 500, so we got that 500 there on the end. Remember, we also said it's $1.85 per 500. So that $832.50, I still have to add an additional $1.85. So that would make it $834.35. So obviously, so my guess is, obviously the right answer is $834.35, but I bet one of your options would be $832.50, which would be wrong. Be very close, but it's wrong, because you forgot to add that extra $1.85 for that 500 on the end, right? They'll probably have an answer to show, if you put that instead of the 225 times 370. Like I said, some people, they'll put 225,000 times, which is an enormous amount of money. Y'all, you should be able to just look at that and just know that can't be right. But you'd be surprised. But anyway, y'all, that's all there is to the deed stamps. Again, just make sure you memorize how much they cost, because I'm telling you, they're not going to provide that to you in the question. $370 per thousand, $1.85 per 500, and if the sales price is not an even 500, then you must round up to the nearest 500. Y'all, just one more quick example. Y'all, let's say the sales price was actually $225,600. $225,600. Well, it's not even 500, so I got to round it up. So if I round it up, that's going to make it 226,000. So now all I have to do is take the 226 times 370, and that's it. Because there's not an extra 500 on the end, I don't have to worry about adding that $1.85, right? So you only add that $1.85 on the end if you rounded it, or if the sales price, either as it is or after you round it, there's a 500 on the end. Okay, so hopefully that helps you out a little bit. All righty. Well, I hope you do well, and good luck with your closing details.